Here with three gentlemen who have had long careers in the area of ILS and alternative capital markets, so we're going to pursue that a bit further. To my immediate left is Aditya Dutt. He is a Senior Vice President of Renaissance Re Holdings and the President of Renaissance Underwriting Management, with responsibility for managing the company's ventures, including Da Vinci Re, Top Layer Re, as well as other ILS capital markets activity of Renaissance Re Group. Further to the left is Beat Hollinger, who's a Managing Director at Munich Re Capital Markets, also responsible for ILS activity at Munich Re in trading and also establishing solutions for Munich Re clients in the capital market space. And at the end of the panel is Gary Martucci. Gary is a director in Standard & Poor's Rating Services. Primary responsibility as our lead analyst in rating insurance-linked securitizations, other insurance capital markets solutions. So thank you all for joining us this morning. So I want to start out just by setting the stage, as we've talked quite a lot about new capital in the sector, and what it means and how the dynamic has changed over the last couple of years. Maybe just to get your very broad perspectives on how you've seen alternative capital changing the environment that you're operating in, what you've seen evolving over the last couple of years, and what, if any, impact has it had on your firm's strategies in the marketplace, starting with you, Aditya.
Sure. So thank you. Good morning, everyone. I think it's pretty simple. What we are reading about now and discussing now is a trend that's been happening for about 10 years, which is businesses that are profitable and non-correlated to the securities markets attract money. And we've seen that really pick up pace in the last couple of years. But what we're seeing is a new form of capital coming to our business. And the challenge is, how do we harness its power? How do we use it? But very simply, that's what we've observed. To us, we started our joint venture business about 15 years ago. So we believed that diversifying our capital sources was actually a strategic imperative a long time ago, and we built our company that way, over a decade ago. So I think your question about strategy, does it inform our strategy? Absolutely. Does it change the way we're doing things? I don't believe so. But the influx of what we've seen is pension plan capital, long-term capital, institutional capital has picked up pace, in my opinion, at least significantly over the last couple of years.
And just in terms, though, of your long participation in those sort of joint venture arrangements, call them permanent sidecars if we want. Has this market dynamic changed the way you use those vehicles, the way you view them as part of your capital structure and source of capacity?
Yeah, absolutely. I think I'd answer the question slightly differently than you asked it, which is, do our customers value it? Yeah. So we try to come at pretty much everything we do from our clients' perspective. Do our clients value this capital? Does it diversify and improve their cost of capital? We're effectively a capital provider to the insurance industry. Are we efficient in the way we do it? So yes, from that point of view, it informs our capital structure, but it's also a business tool. It's not just a capital management exercise for us. It's how can we best give you an example. A customer wants to buy $100 million of reinsurance. If we like that line or that layer and we want all of it, what's the most effective tranching of that layer into various sources of capital? And one source of capital for writing that entire layer may not be the right answer. It may be, it may not be. And that's how it informs our judgment that should we put it into 3 or 4 different classes of capital, that each of which works hardest against the risk that's given to it. So that's how I'd answer it.
Okay, thanks. Beat, your perspectives from how the evolving markets affected your business, how it's affected Munich Re's approach to alternative risk transfer?
Sure. Well, thank you, first of all, for having me, and good afternoon almost already. Is it friend or foe for Munich Re? Let me start with the latter one. Is it a foe? If you look at the business, at Munich Re's business that is impacted by ART, it's about 10% of our premium on the P&C side. Let's ignore life and health. It's just 10% of P&C. So if you would have a 10% rate on line change on this 10%, you can find out to which extent our income statement is impacted by ART at this point in time. So is it foe? Not necessarily. And it has a small impact at this point in time. Is it friend? Yes, sure. You had mentioned cost of capital. We follow a pure cost of capital approach. So if you realize that transferring risks from our balance sheet to the capital markets makes sense, then we do it. We have our Queen Street program, so we issue cat bonds quite on a regular basis. So yes, we do it if from a cost of capital perspective, it is beneficial to get rid of some risk of our balance sheet. At the same time, we look at cat bonds from an investment perspective. Does it make sense to invest in a cat bond? If a cat bond has a higher, RORAC than a traditional reinsurance, why should we not invest in a cat bond? So that's why we have become one of the 10 largest, cat bond investors over time. You mentioned the client perspective. Obviously, if a client wants to do a capital market transaction, we think it makes most sense to work with a reinsurer to such a deal because of our, underwriting experience that we have, our insight in the models, and our understanding of the capital markets. So overall, it's more friends than foe.
Gary, just in terms of what comes across your desk at S&P, and what's changed, what stayed the same over the last couple of years?
Well, what we've seen is we've seen more volume starting to pick up again. The biggest year we ever had was 2006 after the 2004-05 hurricane season. There was some capital issues that people were concerned about, and the prices, the rates were very high in the cat bond market, so that was our busiest year. But since then, what we've seen is what I consider new entrants into the field or into the issuer space, excuse me. So the fair plans such as North Carolina, Massachusetts have issued bonds that we've rated. Louisiana has issued bonds that we haven't rated. We've rated transactions from the California Earthquake Authority and most recently for the Metropolitan Transportation Authority, which suffered losses from Sandy. So I would say that's the biggest change we've seen is just the introduction of new issuers into this space that you wouldn't traditionally consider as wanting to access the capital markets. And I think it's a favorable development. It's good to diversify their sources for these companies, and it provides protection. Because a lot of these companies are essentially the issuers or the writers of the risk of last resort, so it's good for them to have access to the capital markets. And even recently, post-Sandy, I've been getting calls from either state development corporations, other transportation authorities, also just trying to understand the process of how the cat bond was rated, and just so they get familiarize themselves with the market as well. So it looks like other people besides just traditional primary insurers are focusing on this market.
And there's been a trend as well and I think this is a reflection of some of the new capital that's come into the market, that the non-rated space has also been growing at the same time the rated space has been growing at a decent rate. So is there a fundamental difference in the characteristics of what gets rated, what doesn't get rated, just in terms of what you're seeing?
Well, it's a few different reasons. Part of it is Rule 17G5, which we have to operate under, and there are certain indemnifications that are required that issuers aren't necessarily comfortable making. Sometimes deals just replicate themselves. So recently there was a transaction rated this year, and then a few weeks later the issuer came out with another transaction very similar to it. So they really didn't feel they needed to do it. And
was that Munich Re?
No, it was not. But on other times, it seems to be more in the lower rated space where if you were to get a transaction in the B or B minus range, the people who would buy in those lower tranches, if you will, tend to be comfortable. Because this is a relatively small investor base when you consider the broader capital markets, and the people that buy these bonds have their own modeling capabilities. They have people on staff who are meteorologists, geologists, et cetera, who can also model out the risks. So it's a combination of things that would try to bring, not necessarily have a transaction rated, but still we do, the vast majority of cat bonds do get rated.
Just, I'm interested in the angle of you mentioned the FAIR plans and some other government agencies, government-sponsored agencies getting into the market. I wonder, Beat, if you have a perspective on, that's a relatively new segment of the market. There have been a number of recent high-profile transactions. Is that a reflection of the primary insurance market not serving these types of institutions? Is it bad risk that the market doesn't want, or are there other drivers, as you understand them, to this sort of diversification of the issuer base?
I don't think it's necessarily bad risk if you look at the transactions that have been done for government entities in the last 12 months. North Carolina did 500 million. The Turkish Earthquake Authority did 400 million. Mexico, for the third time, did now 300 million. It's certainly a risk that can be, for which models are available. I think that's a very important precondition for a successful transaction. And so the risk per se is not a bad one. It's just the fact that this insurance might not be available on the primary insurance side. And these are lender of last resort, they want to have access to collateralized, high security, multi-year protection. In case something comes up, they have access to liquidity. We've been involved in all the transactions I mentioned before, but specific to Mexico, Mexico has done this transaction to have access to liquidity in case of event for cleanup costs. So it's not necessarily primary due to the build-up of new infrastructure. It's really have liquidity to clean up after a strong event. So that there might be different motivations why they do such a transaction. So in the Mexican case, they did it on a parametric basis in order to have the payout time limited to a minimum so that they have access to liquidity means.
Yeah, I think that's an interesting area, and there was some conversation amongst the CEOs that spoke this morning about emerging markets and the fact that I believe the statistic quoted was 85% of the property and casualty premium is in Western Europe, North America, and Japan, and there's little to no growth in those markets. So where are insurers and reinsurers to find their growth? Looking to emerging markets, and yet we haven't seen the ILS make it to that space yet. The Mexico, I guess it was their second deal? Third deal, sorry. And the Turkish deal. Outside of that, and you look at the recent events in terms of Philippines, in terms of Haiti, Chile, et cetera, there's definitely a need in those markets. Is that need in the emerging markets better served by the traditional reinsurance market? Is it not something that's yet ready for ILS in terms of the understanding of the risk? Do you have an opinion?
Yeah, I think, so interesting question. Earthquakes and hurricanes don't really care about developing or non-developing markets. They strike at will. But if you think about where the total P&C cat market, let's stick with cat for a second, is about $300 billion of limit that's placed in the world every year. About 40% of that is the United States. So 40% of the limits, the covers that are bought are just the United States, followed by Europe, followed by Japan, followed by Australia. So actually the amount of limit that's placed worldwide for cat in the world is very little outside of those four areas. If the US is 40% and the reinsurance industry, let's say, just takes an index of the whole market, everyone's portfolio is roughly 40%. So when you get a piece of risk in Chile or in India or China, it's very diversifying to the United States. So actually our capital, rated balance sheets, is very efficient for non-US risk, is very efficient for the emerging markets. So it's difficult for, if you look at a pension plan or a private equity fund or a hedge fund, the logic for why they can price effectively in our market is because they're diversified against the capital markets. Actually, we have the same logic against the emerging markets. It's diversifying for both of us to an extent where actually we're pretty efficient capital outside of the United States. So I think that explains part of why perils outside the United States have not been securitized into the capital markets, because it is still pretty cost effective to buy traditional reinsurance and to buy it with speed, have large lines provided to you by the likes of Munich, Swiss, ourselves, and to transact very, very quickly with a partner you've known for 20 years. So it's straightforward. Beat, you.
What is an interesting comparison you made is that 40% on the traditional side is for the U.S. On the cat bond side, it's 80%. So that's where you see where the beef is in the market. It's 80% U.S., 60%, more than 60% hurricane, the rest hurricane, and the remainders is really the rest of the world. So in capital markets, of course, they access first those perils, those risks who have the heftiest margins. And this is obviously U.S. hurricane, it's California earthquake, it's European wind, and coming up, and the Australian risks. So capital markets with the interest rate environment and with the diversification need they had, of course, the first access is the high-paying risks.
So I want to talk a bit about the sources of the new capital coming into the markets and what it means in terms of the permanence of that capital, what it means in terms of impact on reinsurance pricing, the profit margins. We've heard different comments over the last couple of days about the relative hardness or weakness of the market, and just let me share one anecdote about the capital coming in this market. I was writing a Sella to Washington a few weeks ago. Clearly, gentlemen with a certain amount of investable wealth, and one explains to the other gentleman that his financial advisor just got him into a cat bond fund. The other guy says, "What's that?" My ears perked up. I didn't want to contribute. I just wanted to hear what they had to say, and he said, "Well, I'm investing at a much higher return than I can get in anything else. And there's a small risk that something bad's going to happen, a hurricane, and I'll lose a little bit of money, but everything's diversified, so there's really no worry there relative to the return I'm getting." What I'm getting at with the anecdote is, and I don't think those guys like the one across the train from me are the predominant portion of the alternative capital coming in, but they're a facet of it. And to what extent do you think that new capital is maybe naive, maybe doesn't fully understand the risks the way that a RenRe, a Munich Re, others in the reinsurance community would analyze the risk-return payoffs? And what kind of impact do you think that potentially naive capital has on pricing and on the hardness of the market going forward?
Go ahead.
Well, we think it's pretty sustainable at the situation where we're right now. If you look 15 years back, that's basically when the first ART transactions were placed, and the forecast was this market is poised to grow substantially over the next few years. It has never happened. It really took another 10 years for the market really to start growing, and then obviously we had 2008. That put a little bit of halt on the development. But since then, we've seen sustainable growth from pension fund money coming into the market. So it took the pension funds a while to commit to this area. They needed to have the track record. They needed to make sure, through which channels they would invest. So they very carefully, made their investment decision, and finally they made it and they committed capital. So it took them some time to get into the market. It will also take some time to get them out of the market again. I don't think a loss, a capital loss, will make them withdraw their money. Look at 2011. In 2011, we had 14 billion of cat bonds outstanding. I'm referring to cat bonds because that's the most transparent instrument available in the ART space. So 14 billion of capital outstanding. Let's assume, for simplicity reasons, 7% rate on line. So that results in 1 billion of interest income if you were to own the entire cat bond portfolio. We had the Tohoku event that resulted in a total loss to one cat bond, 300 million. We had the tornado hail activities that resulted in 200 million of capacity loss. So in total, 500 million of capital destroyed. If you deduct this 500 million from the 1 billion of interest income I mentioned before, on the net basis, you still have 500 million. So if you have a perfectly diversified portfolio, you were still positive, even the fact that you had two total losses to a cat bond. So I think investors are okay with that. if you look at the ratings of these bonds, mostly they're in the single B or double B range. So that's, excuse my language, but that's junk bond status. You expect to lose money at some point in time in these bonds. But if these events do not occur 5 or 6 times a year, you're fine just with the fact that you have substantial investment income from which you can deduct potential losses. So that's why we think that this capital will stay in the market. Whether it's naive or not, I let others decide. We have been in this area for 133 years, so we have some sort of understanding. Who knows what underwriting of risk means, or who is able to underwrite the risk, and who is not that capable of doing that. What we think will happen with inflow of capital, that cycles will get shorter and less volatile.
Aditya, your perspective?
Yeah, no, I agree with Beat. The bottom line is, do we think the capital's here? The answer is yes. I think it's pretty difficult to argue against it. I'll play devil's advocate for a second. There are a couple of things that give us pause. Number one, I think we as an industry, CAT in particular, overestimate our importance to the pension plan business. If you're dealing with a $100 billion pension plan, who is managing a $50 billion fixed income portfolio and let's say a $50 billion equity portfolio. To them, the reinsurance business is a niche and nothing more than that, because you cannot deploy more than a couple $100 million at a time. So even if that portfolio manager loves our space, they can't write a big check, right? So it'll never drive their portfolio. It'll be a very small, niche-y, a diversifying thing that'll be a pretty small part, right? So we're not turning into PIMCO here, and we're not going to represent the fixed income market or the currency market. We are a very, very small piece of that market. I don't know if the numbers have been presented, but it's roughly 50 billion, right? Even if it doubles, so what? That's nothing. Even if it triples, so what? I'm speaking from the perspective of a $200 billion Canadian pension plan. What difference does it make to them? They can't put $5 billion to work. They can put 200 to work or 500. So it's pretty small for them, which that's the one thing that gives us a little bit of pause, that if something else comes in vogue, and investing markets work like that, things come in vogue. If it comes in vogue and they say, well, actually, I'm getting paid 20% in timber. That's what we compete against. It's not. We don't compete against fixed income because we can never be that big. The other thing I think is the question I think we as an industry should ask ourselves is not whether the capital will stay or go. It's here now, and it's probably going to stay. Are we building durable franchises to harness that capital and to store it in our industry in a productive manner? That's really the question that our clients are asking us, our capital providers are asking us, is can you take this in a way that's productive for me and you? And I think there's a lot of talk about, will it stay, will it go, is it going to triple in size? To us, to RenRe, those are not relevant questions. It's let's assume it stays, and in 10 years, how can we create a franchise that benefits, three of our most important constituents, which are our customers, our shareholders, our employees, and you have to answer those questions. That why is this good for my three constituents? So that, frankly, we care about that more than is the capital sticking around or not. I agree with that. It's probably here to stay.
Just in terms of, Beat brought up the underwriting cycle and what it really means. And Gary, you see a lot of, former cat bond issuers that sort of leave the market, or new ones coming in. What are you hearing rhetorically about the cat bond pricing dynamic, reinsurance pricing, how it's affecting transaction sponsor behavior at this point?
Well, yeah, I think the prediction is that it's going to be a very busy fourth quarter and continuing on through the first quarter. Issuance is going to be all-time highs. It's been a bit slower in the fourth quarter than people were talking about. We were, supposed to be working on a transaction where, but then we were told that the issuer had talked to his traditional reinsurers, and they found out that the pricing that they could have gotten in the cat bond market would likely be equal or below that of, so they decided to put everything on pause for a while just until they can firm things up. And then from other sources we've heard too that the reinsurers aren't just going to sit down and let things, just take this in stride. They're actually going to be fighting on, lowering their rates somewhat to compete with what's going on with the cat market, because they view this as a significant portion of their business. So, the January renewals are coming up right now, so we'll see. I think it's going to be a bit of give and take. We'll probably see some new issuers coming to market, but I don't think it's going to be as busy or as active as people were originally predicting.
Bad, you're seeing both sides of this. What's your perspective?
Well, when we talk to clients, obviously, ART is a topic. The decision whether to do a transaction or not, has to do with the strategy. Is it really important for them to access third-party capital because they want to have collateralized protection on a multi-year basis, or are they saying the group of reinsurance that we have assembled for our reinsurance program is so good, we don't want to mess up with them by just doing a transaction, taking one of the layers and transferring it to the capital markets. So we had these discussions as well. But on the other side, of course, some people, especially when they increase their reinsurance program, they say, okay, we can do both at the same time. We can keep our traditional reinsurance happy while accessing a new source for a new layer that we introduce. So it's a combination of the two, actually.
So Aditya, the market is hardening, softening. What is the impact that this new capital is having on the traditional cat reinsurance market at this point?
Well, we typically provide no commentary on whether it's hardening or softening. That's for everyone to decide. I think the impact of the capital, let's just step back and say, why is it even coming in? Why should this capital find a home in the reinsurance business? The answer is for our balance sheets on a rated basis, because we can write more than $1 of limit against $1 of capital, work hardest in a diversified portfolio. We need diversification to make our capital work hard. As you get a more peaky and more concentrated portfolio, collateralizing the limit makes sense. So that's why we see capital coming into the ILS end. And most of ILS, as Beat said, 80% US. Most of that is hurricane. So it's going to the place where it's efficient. That makes financial sense to us. And what it's doing is pushing pricing down. I hope I'm not shocking anyone in this room with that statement. But that's what it's doing. And what it is essentially more efficient capital against the risk that deserves it. So it's not that margins necessarily are being compressed. It's the top line price may go down, but the cost of capital that's funding or financing that risk is also lower. So actually it's not necessarily doom and gloom for the reinsurance industry. Again, as I said, if you can, we talk a lot about price and rate. We don't focus as much on margin. Margin is a function both of the price you're getting on the front end and the source or the cost of the raw goods that you're sourcing. In our industry, the raw goods is your cost of capital. So yeah, I think you can safely say prices, the trajectory is flat to down and has been for a couple of years. Partially responsible for that is more efficient capital. But again, I think it's unfair to say, well, pension plans are causing this. I don't think they are. I think they're providing a more efficient alternative to a customer, and a logical, well-informed, intelligent customer saying, I'll take it. And that's a very logical decision to make. So our challenge as their service provider, as their reinsurer, is can we give them that capital as efficiently? But again, hard for us to say, or we won't say, whether markets are softening or hardening. It's each company's portfolio is so different that it's difficult to say that.
Yeah, I mean, it's no big surprise that rates are coming in a little bit, having not had a landfall for 5 years. I mean, let's look at Superstorm Sandy. Superstorm Sandy caused a loss of 20 billion, right? What happened? The downturn of the price stopped for a little bit until the next renewal, and then they went down again. So for me, the bigger question than the impact of a pension fund is, what kind of event will it take for the market to turn again? We saw a 20 billion loss has not helped the market to turn, towards increasing prices again. So will it be the 50 billion event? Will it be the 100 billion event? The jury is out there. The fact is 20 billion have not changed the market.
That's a big question, and I have to say some of the comments that came out earlier about the new capital being here to stay. I get, perhaps I'm a little bit skeptical about that, and particularly to the extent that you do have the $100 billion event, either one enormous hurricane or maybe a combination in the same season that wipes out half a dozen bonds. Do some of these portfolio managers, risk managers, what have you, that represent part of the new capital, do they get skittish? I know historically the reinsurance marketplace has had no difficulty recapitalizing after major events, but are those the same investors? Or are they a different set that might actually get frightened away when the big event actually does happen?
I think it will be a combination.
Yeah.
I don't think, as I said before, that pension funds will withdraw from the market after they suffered a loss. And we all know what's happening if a big loss has happened. Capital comes in from all various areas. Maybe the hedge funds will become more active again. They're withdrawn because they have seen other investment opportunities yielding better prices. Maybe not offering the same diversification as cat bonds do, but they obviously exited the market at some point in time. So you probably will see these back again. But I think that's more opportunistic money than the pension fund money is. So as I said, I think it's going to be a combination of the two.
Any other perspective?
Yeah, no, I'd agree with that. I think there are many outcomes, and it depends on the event, it depends on the external environment at the time. I'll give you two ends of the spectrum. Some of the smartest investors we know in the reinsurance space are actually pulling money out, okay, if that tells you something. So they applaud buybacks, they're applauding capital management, capital return. Some of the smartest people we know are doing that. They've lightened up, or they're flat. They're not increasing at least. And I think there will be some people who will be surprised because their level of diligence wasn't as rigorous as others. The other factor in that is how much in the cat business, it's not which event hits you, it's which event surprises you. I think every reinsurance presentation sitting on a pension plan's desk says, well, if you have a $100 billion Florida event, this is what happens. They know that. What they don't know is the parallel of World Trade Center is that was a surprise. It's unmodeled. No one saw it coming. It's unpredictable and it's large. That's what scares people off. It's not the modeled events that everyone knows about, or at least they think they know about. It's something that changes the market and causes both reinsurers and capital to exit very fast. And that's the hard one to predict. We just don't know. I always use the example of what if China has a very large event and starts buying a ton of reinsurance. Suddenly you've just changed the balance of what's purchased in the world. And do we have robust enough models in China, as we do in the United States, to write 50 billion of new limit there? I don't think so. That'll change the market. But California, Florida, I don't know.
And I'll turn to the audience for your questions in just a moment. I wanted to pursue what you mentioned a moment ago about cost of capital and evaluating your cost of capital trade-offs, where to deploy it the best. And I know, given where risk-free rates are today, if we still know what that term means, I think the way you evaluate your cost of capital, your best deployment of capital, is maybe different than in a more normalized environment. And at the same time, some of these new capital investors in the market are certainly driven by the low rates of treasuries and corporate bonds and other types of alternatives available to them. And that's pushed down the yield on ILS to a degree, I think, certainly on what we've seen issued in the past year. So just can you talk about interest rates, the paradigm, how you see it affecting the market, your decisions about capital allocation, and assuming we get to a more normalized rate level, what would you see as the possible market impact of that?
I guess I'll start first. There's a very simple and obvious one. So insurance balance sheets are leveraged, meaning we typically have an asset base that's larger than our equity base, right? On average, 2 to 3 times, right? So there's a 2 to 3 times disproportionate positive uplift to a reinsurance balance sheet compared to a fund. Right? So if rates go up 100 basis points, that's 300 basis points of ROE for a reinsurance company that doesn't, an ILS fund would get the extra 100 because they're a spread-based business, but that's all they get. So suddenly the reinsurance balance sheet starts looking more efficient and better. That's certainly one impact of it. The other one is, do fixed income investors, writ large, pension plans, big institutional investors, just say, okay, now I'm making 5% yields in the single A corporate bond market. I really don't need to. I don't need to be in ILS. It's small. It takes a lot of work to understand. And if I'm only getting paid 25 basis points more, I don't need to do that anymore. Those are the two things I would say. Yeah, you're closer to the market.
It's difficult to say, but what you have basically the compensation, the cap on is risk-free plus spread level. So you really have to look at the dynamics. Is only the risk-free changing, or is the spread changing at the same time? So you might have cases where the risk-free goes up, but the risk spread as well. So then ILS stay competitive with other financial market tools. If only the risk-free changes, but the risk spread, the rate on line stays stable, then yeah, there might be the case where you have more competition from other financial market tools. What you then still have to take into consideration is the benefit you get from investing into insurance products. Investment products are not correlated to financial markets risk, interest, credit whatsoever. So that has a benefit as well. So I think you have to clearly assess the situation you're in and then make your decisions accordingly. It's not that simple that we can say, oh, risk-free goes up, cap bonds are not in fashion anymore. You can't say that. It's not as simple. It's really it's a dynamic system that we're exposed to, relative absolute changes, and also what's happening outside of the cat space.
And a little bit going back to the point about potentially naive capital in the sector, do you feel that modeling capabilities and understanding of the risk are a competitive advantage to you in the market as occasional cat bond investors in addition to traditional reinsurance providers, and perhaps able to make better risk selections and better evaluations of ILS opportunities than maybe some of the investors in the market that don't have the same understanding of the risk?
We would certainly hope that we have an advantage. We've been doing this for 133 years.
Cat bonds? No.
No. Assessing risks.
Yeah.
Cat bond Invest has done that for 10 years. However, the jury is still out there. Who's right or wrong? Whose model is right? Is our model right? Our Munich Re model, which tends to be different to the third-party models that are available in the market, and who write cat bonds? Who knows? I mean, look at the 1906 earthquake. 1906 earthquake is considered to be the 1 in 100-year event, right? So if that 100-year period has started in 1906, then you're still fine. We're still in the second 100 years. You have 93 years to go until it's proven that it is truly a 1 in 100 event. Looking only at 200 years, which obviously is totally. Yeah, no, let's not go there. If the 1906, 100-year period has stopped in 1906, then we're overdue. So the stats is wrong. So whose model is right or wrong? We will not learn in our lifetime who's right or wrong.
Ren's model's always right?
Yeah, right. Yes, the black box says yes. I think we actually believe, our chief risk officer says this all the time, all models are wrong, some are useful. Now, I think we have, as an industry, increased our dependence on models. The cat bond market, to me, is actually kind of shocking because we've seen reliance on one model in the last 12 to 24 months.
Yes,
Yeah,
well, since the 11 version of a certain risk model.
Yeah, so it's really, and nothing against that model. The principle is, should you have multiple views on risk? Should you have a independent, what makes markets work are a buyer and a seller don't share the same view of risk.
Mm-hmm.
Well, actually, if the sponsor and the buyer are both using the same model and have been for a long time, I think you get this sort of groupthink around this thing is right. And I think one thing we can say for sure is no one model is right. And developing multiple views of risk, even if it's something as simple as using two models, you don't have to spend money on your own, but does it improve your risk-taking ability? Yeah. So I think that's it's an interesting development. As Beat said, in our business, because risk is losses are remote, it takes a while to discover who's right and who's wrong, and we may never discover it in our lifetimes.
Yeah. In terms of where you see the market going from here, new perils, new regions. I know Munich has dealt some in longevity as well, which is a market that we've talked about for years that's not really blossomed despite the need for the product. Are there any things that you see in terms of new emerging developments to look out for in terms of where the market's going and how this new capital might be getting deployed?
I think there are two questions we have to ask ourselves. For which perils do we have models that have been tested well enough that they can be commercially used in a cat bond transaction? And the second one is, are there other perils such as US hurricane that have a rich enough margin to make them attractive to be transferred to the capital markets? Now, we've been discussing other perils, workers' comp, casualty risks, and so on. What have we seen placed in the markets? It's basically nat cat for events for which we have models and that are priced rich enough to make them attractive. On the casualty side, how do you deal with the tail? How do you address basis risk? Who's willing to take the basis risk? What's the price? What's the right price of basis risk? They're very complex questions to be answered. I think the more mature the market gets, I think we'll see more perils coming to market, but I think on a slow pace.
You see anything new on the horizon?
Yeah, I think we agree with Beat. You can only do two things. You can create demand or manage your capital more efficiently. I think all good reinsurance companies try to do both. There's a couple of things on the horizon: flood, terrorism. There's some interesting developments in the United States, at least, with respect to both those lines of business. That could be game changers for our industry. On the capital side, which we've been focusing on, obviously, big changes happening. But our outlook is actually is pretty exciting. As an industry, I think we haven't seen changes like this occurring in the property casualty cat industry in a long time. And I hear a lot about our market being commoditized and everyone kind of looks the same. I really disagree with that. I think the opportunity now that the world is giving us, the capital markets are giving us, is actually distinguish yourself. And if you do, and if you take advantage of some of the things that are happening, you can be a real winner 5 or 10 years down the road. So actually we, despite the talk about pricing, et cetera, we like to focus on what are the opportunities for our company to grow and be a better franchise for our shareholders. So we have a pretty optimistic outlook.
And you brought up something that was a subject on the chairman's panel this morning, where somebody suggested maybe the time has come for the commercial market to take back flood risk in the U.S. as well as obviously, depending what happens in Congress, terrorism risk may come back into the commercial market as well to some degree or another. And I think we would at least have the view that the models either aren't there or aren't tested enough in the terrorism area. Flood, maybe not. I mean, how do you feel about that prospect that it comes back to the commercial market and that risk plays a role in the capital markets going forward?
That's kind of the beauty of it, actually, is that there isn't one. And if we all tout ourselves as being good risk managers, we ought to develop one. I mean, it's not impossible. It's tough, but it's certainly not impossible. So if the vendor models don't have one, and companies like Munich or others have put in time to develop a flood or a terror model, it's their advantage. So I don't think we should worry as a market we don't have something publicly available or available to us to do this. All that's saying is, well, it's not easy. That's okay.
Yeah, and there are distinctive reasons why a private market does not offer certain protection for certain risks. I mean, look at the Munich Re or the German market. In some areas where you have river meeting like the Donau or the Danube or the Inn and another river, you don't offer flood insurance simply because of the fact that floods occur there once every decade. So why should you offer risk protection in this area? That's a risk management steering instrument as well, not to offer something, so not to incentivize people probably to expose values in these areas just because of the fact the event will happen rather sooner than later probably. And on terrorism and modeling, that's a very tricky exercise. The certainty around such a model is tending towards zero because you never know where it will strike, how it will strike. Will we see more events, but to a smaller extent, more like guerrilla type of attacks rather than the big one, as we have seen on 9/11? That's very difficult to assess. So I'm less optimistic on terrorism than I am on flood.
And we've actually rated some instruments in some other parts of the world linked to flood, but
Yeah, we've done one.
not so
flood
much
trend.
terrorism.
No, I don't think we'd be changing our view on rating terrorism-linked
No.
bonds.
Yeah.
We had, there's one that I'm aware of, we did not issue a rating on that. We have rated one flood bond, that was back in 2007. But one other thing we've seen is, at least heard some interest in, is, well, it's not Nat Cat per se, but it's auto lines, people looking to access the market to cover that type of risk as well. We saw Aetna issue their vitality deals over the last 3 or 4 years, so they've tried to cover the risk of claims to premium. So I think some other lines might be subject to similar type of technology to try and cover those risks as well.
Do you see Solvency II at all as a driver? And there's an argument that Solvency II keeps getting pushed back enough. Maybe it's not a driver for anybody's behavior at this point. But in terms of views on risk capital, the role of ILS, do you think it drives activity eventually for your firms or client firms?
Well, the question is, as you're saying, when will Solvency II be introduced, and how does the actual regime really look like? Then it can be properly assessed whether alternative risk transfer solution makes sense or not. I think it's too premature.
Given none, I'll thank my panelists. Hopefully you'll join me for the panel discussion this morning.
Good afternoon, ladies and gentlemen. I am Farooq Umar, a Senior Director and the Analytical Manager for the reinsurance practice within Standard & Poor's Rating Services. Before I get into my comments, I would like to confess that it's never easy to be the last speaker and be standing between the food and the audience. So I'm going to keep my comments fairly short. So I would like to thank you all for attending the 8th Annual Bermuda Reinsurance Conference and for contributing to what has proven to be a vigorous dialogue. These discussions with market participants, they help Standard & Poor's maintain its commitment to transparency along with global comparability of ratings, and enables us to issue forward-looking opinions on creditworthiness. So each year, we strive to improve upon previous conference. And I must admit that it was a mission accomplished this year. Between today and yesterday, we have heard a lively discussion of the factors that will be impacting and driving this industry forward. Among the key takeaways, first, convergence, which continues to be the hot topic for the industry. As the influx of third-party capital is reshaping the landscape for the reinsurance industry, and the question really becomes whether the reinsurers will become the victim of their own success, and how long will this trend continue. And second, of course, we know that the hunger for yield goes on. Specifically, if you combine that with the slow economic growth, that is really forcing the reinsurers to look into the alternative sources of capital, such as cat bonds and sidecars. And the combination of these two factors is testing reinsurers who, while still well-capitalized and delivering returns, are looking to position themselves for sustainable growth and profitability. These long-term objectives are driving them to enter new markets, add new lines of businesses, and introduce new products, which may add to their business risk. So, needless to say, all of these trends mean that there is an unpredictable road ahead. This will require close monitoring, as the outcomes may not be immediately clear and will take some time to clarify. So with that, the question becomes, how many of those currently involved in the industry will be here next year, and in what capacity? As Greg noted in his keynote remarks yesterday, life can be understood backwards, but it must be lived forwards. And given where we were a year ago, emerging from the wake of Sandy to now, where the industry is an intense focus of alternative capital, I think we can all agree that we are entering into an interesting period, and perhaps even revolutionary period for the industry itself. So we look forward to continuing our dialogue with you. That has marked this event. And once again, on behalf of Standard & Poor's and PricewaterhouseCoopers, I thank you for attending and participating in this year's conference. And we wish you safe travels and look forward to seeing you again here next year. Thank you.